after the short tea break, and we hope you all had a lovely break to meet each other. We request all the participants to kindly settle down as we move to the next session. The next session is the plenary session on climate and disaster risk management for financial sector. The plenary will focus on the significance and future landscape of climate risk management in the financial sector. Given the urgent need to catalyze climate risk management for finance institutions and national banks to mobilize adaptation finance, the discussion will focus on the challenges for integrating risk, including limitations in data availability, regularity standards, and capacity. It will also delve into emerging approaches to improve risk management in the financial sector for addressing the impacts of disasters and climate change. This session comprises two segments. The plenary discussion centered on climate and disaster risk management within the financial sector, followed by a dialogue and a showcase of the Global Infrastructure Risk Model and Resilience Index. I welcome all the distinguished panelists and the moderator to the stage of this session.
Across the world, infrastructure systems are increasingly affected by climate change and disasters. Investments are essential in disaster-resilient infrastructure. But to invest, banks and financial institutions need to understand the risks posed to investments across their portfolios from climate change and disasters. Building on the ICDRI platform, ICDRI, along with Dalberg Advisors and CPI, and supported by the Rockefeller Foundation, is designing a playbook to manage natural hazard risks in the financial sector by assessing losses due to natural hazards, predicting the effect on investments, combining international methodologies to contextualize risk assessment. The playbook will identify data to conduct an analysis of natural hazard risks linked to climate change. It will also evaluate the risks from natural hazards to key financial risks that may affect investments. Through this playbook, ICDRI will provide a model for all countries to develop similar roadmaps and manage natural hazard risks in their financial sector.
This plenary session will be moderated by Mr. Govindraj Ethiraj. Mr. Govindraj Ethiraj is the founder and editor of India Spend and founder and podcast host of The Core Report. Mr. Govind Ethiraj is a television and print journalist who has reported and written on Indian business for over 25 years. He is a media executive and entrepreneur whose public interest journalism ventures use data to tell stories in areas like health, education, and climate, as well as safeguard the transparency, accuracy, and incredibility of news. He also hosts a weekday podcast called The Core Report, which is already in the top 3 in India. Earlier, he founded BoomLive.in, an independent journalism initiative that fights misinformation and explains issues with the larger objective of making the internet safer. He also founded the award-winning India Spend, a public interest journalism outfit, which uses data to write and syndicate stories in areas like health, education, environment, and fact-checker, which monitors media, politicians, and other figures for accuracy. Govindraj also sits on the global board of the St. Petersburg, US, headquartered IFCN since inception. Govindraj was named a 2018 McNulty Prize laureate in recognition for his leadership with Boom, India Spend, and Fact Checker. I now hand over to our moderator for the session, Mr. Govindraj Ethiraj.
Thank you very much. Okay, so the first thing is that we've got 1 hour to go and we are roughly 25 minutes behind schedule, as I could see. So I'll also try and hurry it up. Let me quickly introduce our guests here and my fellow panelists. I'll start off with Vivek Sen, Associate Director, Climate Policy Initiative, India. Vivek is a prominent figure in climate finance and green growth initiatives in the country. His expertise lies in developing innovative finance solutions and mobilizing climate finance, contributing to driving sustainable development goals. Smita Hari, to my left, is President India of Octus ESG. She's a finance professional and with experience across corporate banking, investment banking, sustainable finance, ESG, and impact investment. She holds a certification in sustainability and climate risks from the GARP and leads India operations for Octus ESG. Okay, and our guests joining in from what I can see slightly different time zones. Gian-Piero Naki specializes in climate finance, energy efficiency, and circular economy projects across emerging markets with 26 years of experience and expertise in sustainable manufacturing. He's worked across green economy initiatives for many years. Dr. Nicole Retmer is a partner at Deloitte and a leading figure in sustainability and climate transformation, has driven over 150 corporate transformations globally. She has a track record in developing new ecosystems and client solutions for assessing the financial impact of climate change and has received the SAP Pinnacles Award and the Sustainability Project 2019 Award by the German Council for Sustainable Development. And back here, Kathy Borgman-McLeod focuses on protecting vulnerable communities from extreme heat, leading initiatives like the Women's Climate Shock Insurance. Her leadership in climate resilience and global partnerships has earned her recognition amongst the 20 trailblazing women in climate by Reuters in 2024. She's also a member of the United States FEMA National Advisory Council and the Insurance Development Forum. Alexander Kennedy, Head of Sustainable Finance Solutions at Standard Chartered Bank, joins us from London. He spearheads innovative sustainable finance initiatives, including sustainability bonds and ESG derivatives for his institution. And his contributions to sustainable banking and social empowerment initiatives highlight his commitment to driving positive impact. So if you haven't figured it by now, we are obviously going to look at climate and disaster resilience from a financial lens, and more importantly, or specifically, a banking and financial institution lens. So the 2 or 3 things that we're going to do today, before I hand over to my guests to speak. So there are only 3 or 4 questions as we go along. So first is really identifying risks. What do we mean when we talk about risk in the context of finance? Second is evaluating them. The third is the data and the process and the practices to ensure that this all comes together. So how do banks do it? And how are they lending and on what basis are they taking the decisions when it comes to lending towards projects which obviously have an element of climate risk? And then finally, the challenges and capacity, which I think we may spend a little more time on because this is something that we're still working on. It's only 2 months ago that we have guidelines in India from the Reserve Bank of India, which asks banks to classify and also talk about what they're doing in the context of risk and disaster risk. So that's obviously a very important regulatory kicker to get things going, and which means that banks and the banking system or the financial system has to fall into place trying to figure it out, and therefore discussions like this become very important. So I'm going to now pause and ask our guests and panelists to speak. So a couple of quick rules. Please speak for about 4 minutes or 5 minutes at best. The idea is that once everyone has spoken on this issue from your vantage point, then we use that to have a conversation. Hopefully we also have time for questions from everyone if we can. How those questions will come, I'm yet not sure, but we will try and bring you in. I don't want you to be sitting quietly there. And finally, maybe we'll have some time to sum up, but that will be literally in seconds, if not minutes. So, Vivek, I'll let you go off. You're also going to launch or announce a playbook, so because of which you have the honor to go off first. Go ahead.
Thank you so much, Govind, and thank you, CDRI. It's a real pleasure. So let me first talk about the playbook, and you guys would have seen a short glimpse on the video that was just played. So this playbook has been designed by Dalberg and CPI for CDRI, and is essentially meant for the financial institutions, banks and other financial institutions. It gives them a guidance on how to embed climate-induced physical risk into their lending decision-making process. Now, it is not veering off or taking path of its own. It is mainly deriving itself from the recent RBI regulation on disclosures, and it sort of prompts the financial institutions to make disclosures promptly and also to understand what risks are affecting their portfolio. On the coverage side, it has covered 5 sectors: power, roads, airports, ports, and telecom. And also, in terms of the risks that have been analyzed, there are 4 acute risks that have been mapped across these 5 sectors. So it's flood, drought, landslide, and cyclone. Now, what it gives is a broad guidance on how financial institutions or financial ecosystem players can institute processes within their own institutions to sort of measure and accommodate that climate-induced risk into their lending decision-making process. Now, this work also is taking forward or is sort of builds on what ICDRI has done, the first publicly available open source risk model, which is done by CDRI. So this playbook would be available to everyone. It would be on most likely on CDRI's website, and would be happy to have it circulated as much as possible. But coming back to your questions, and in the interest of time, the risk measurement, I mean, it's a very complex process. First of all, we have to understand that the historical data of disasters would not work here, because as we move forward in time, there will be a lot of divergence in the actual events happening from what is predicted based on historical data. So some framework would have to be designed or would have to be adopted by the financial institutions. I think Sendai framework comes very close. Risk can be quantified as vulnerability into hazard into exposure. And from there, the financial institutions can actually try to frame some sort of indices which are internal, but talking to the overall financial ecosystem, that allow them to measure the risk and incorporate them into their lending decision-making process. Now, saying that is very easy, but what stops them from doing so? And what is at risk? Globally, I think that there was a stern estimate which said that 5% of the global GDP would be at risk perpetually by 2060 because of not being resilient to climate-induced events. So that's the global measure of risk. For a financial institutions, it simply means that your loans can turn bad and you will have no recourse unless you start accounting for those risks into your lending decision-making process. But they struggle because of few things: lack of data, lack of awareness, lack of a methodology, There is no standardization as such in terms of availability of data or a methodology to be in place by which they can frame those and model that into their internal risk indices. So the financial systems are as vulnerable as probably women are in terms of the risk that they face because of climate-induced disasters. But what can they do? So they can prepare themselves, invest into practices that allow them to develop resilience, learn more about disaster risk, vulnerability, use the tools that are available. GIRI is an excellent example of that. There are private tools also available that gives you a sense of what can be the climate catastrophe that is there and how much it can impact a certain region or a location. And from an ecosystem perspective, what can be done is that now we have models that work at a country level and also probably at a regional level. But from a banker's perspective or from a financial institution's perspective, it is the risk at the asset level that are needed. And probably that capability needs to be built in the ecosystem, whereas awareness and adoption of tools and methodologies is something which has to be done by the financial institutions. Stop.
Okay, got it. Smita?
Yeah. Hi, thank you everybody. Thank you CDRI for inviting us. So I just want to give a broad perspective around climate risks and what they mean for banks and some of the things that have been happening in the, in this space. So everybody knows in this room that climate risks are real and, it's over 380, $90 billion of harm for the low and middle income countries. Now from a banker's perspective or from a financial institution's perspective, the most obvious impact would be devaluation of assets and the harming in the repayment capacity. But there is something beyond this that I would just like to touch upon. So it's not just where the borrower's physical location is which the banker has to look at, but also from a supply chain perspective, which many bankers now don't realize because, for example, the Thailand floods of 2011, which impacted a country like Thailand. It actually affected companies across the globe, the US and Japan as well. So what it means that as a banker, I need to map the nodes where these risks are present. The other impact is, from a negative feedback loop, which basically affects the sector as a whole. So if the banker realizes that a particular sector is climate prone, then automatically he stops lending or rather reduces wherever possible. And that actually is like a double whammy. So all this, is suffice to say that climate risks is not just going to impact a banker today or tomorrow, but it's a long-term risk. And in fact, the World Bank had done a study in Philippines on the banking sector. And what they found is 1% increase in typhoon ratio leads to a 2.3% increase in the NPAs. So it's more than double, the effect. Realizing all this, regulators across the world have kind of started, pushing the pedal and bringing out guidelines across markets, developed markets, emerging markets. As Govind told, India had come out a couple of months back on climate risk disclosures. Now, I just want to touch upon what the Reserve Bank of New Zealand had done. So, because it's very recent, the results have come out early this week. So they had replaced their annual stress test on bank portfolios with climate stress test last year. And the results were out earlier this week. And what they found was climate impacts are not really going to affect that much the capital adequacy ratios. From a capital point of view, the banks were okay in New Zealand. This was a sample set of banks. But what actually is going to get impacted is the profitability, the shareholders' returns, increase in risk-weighted assets, all this ultimately affecting the bottom line of the banks. And, but what was important from this exercise is they realized where the gaps are in terms of capacities, in terms of data. So it got the ball rolling. At least people started thinking about this. And from an action perspective, the exercise indicated the banks to kind of look at, repricing assets from a climate perspective. So these were some of the, so from a regulator's perspective, when you start pushing the pedal, the banks are nudged to do something, to start thinking on these lines. So there are a lot of examples across the world where banks have started incorporating, climate risks, although in small measures. But the obvious elephant in the room is the availability of data as well as capacities. So tools like platforms like ICDRI, for example, are at a country level, but as Vivek mentioned, how can I translate that to an asset level? So that is the next, kind of step. And from a capacities perspective, Govind, you had mentioned, which is probably we'll delve deeper later, but that is something which comes out in our multiple interactions with banks, that capacities is something which has to be built at a systemic, at an institutional and individual level. The frontline officer in a bank needs to know what this means, So that realization is still a little away from emerging market banks. So I think I'll stop here and maybe come back to these points later.
So you work with a lot of banks and you build capacity, as in you're trying to help them understand what this whole area of risk is about in the context of climate, and then what they should be doing about it. So has your business grown in the last few years, or are you still struggling to?
So I would say that the awareness has increased quite a bit. So when we started off about 3 years back interacting with banks on these topics, there was a lot of resistance even to come for programs not funded by banks themselves. That has changed over the past 2-3 years. So there's a lot of awareness, there's a lot of curiosity because the RBI regulator is actually telling them to do these things, but still a little while away from where we can say we are,
Okay. Can I ask Gian Piero Nasi to take over?
Thank you very much, Govind. I hope you can hear me well, and thank you for the invitation. It's really a pleasure to be here with you today, even if virtually only. I'd like to perhaps start with a couple of considerations on the basis of what the previous speakers talked about. So at ICDRI, we operate in a very diverse region that goes from roughly Estonia to Egypt, from Morocco to Mongolia, so very diverse markets. But let's say there is a characteristics there that, let's say, the climate risks are still not fully understood. There is a degree of lack of awareness in the markets, including in the financial sector. And so there is also a limited amount of financial flows that go towards adaptation and climate resilience projects. So that's a bit and ICDRI, we are primarily a private sector focused organization. Adaptation is a big part of our efforts when it comes to climate change, but it's still a relatively small amount of the total climate finance that we provide every year. It's indicatively 8%. So the way we're looking at the risks and the opportunities in the financial sector, I think there are 3 levels. I like the point that Vivek made before in terms of building the ecosystems. I think that's a bit the idea, because we are not looking at the financial sector exclusively in terms of their ability to manage risks and, on a, if you like, reactive defensive position. But we want to use, as a development financial institutions, the financial sector is also as a conduit for change, as a conduit of increased finance towards climate resilience investments. So that's a bit the perspective. So how to build that ecosystem at the country level? First of all, maybe there is an overarching point I want to make. Partnerships are absolutely relevant. We cannot work in isolation. So it's good to have these conversations involving all the parties. So that's in a way is the basis to have some impact. But I would say I would identify 3 levels. There is one level which is the local awareness, the local capacity, in broader terms, the local policy engagements. And there are 2-3 things we are doing. We have a constant dialogue with the central banks. NGFS, you mentioned earlier, is an important, initiative. So we work with the national banks to engage effectively in these international platforms. But there is also an element of more grassroots, if you like, awareness and capacity building. You may all be aware of the Chapter Zero program that brings together a non-executive director and is designed to share knowledge, best practice, and experience, and brings together, different parts of the economy. Is the financial sector, is the corporates, is perhaps the energy utilities. So we've been working with the Climate Governance Initiative to establish Chapter Zero initiatives in a number of countries. Recently in Turkey, in Egypt, in Ukraine, the Caucasus. So we think it's very important to create this local initiative, again, to build awareness and capacity. There is a second level, which is very important, is also about our lending policy and the way we interact with financial institutions. As of 1st of January 2023, all our lending is aligned with the principles of the Paris Agreement, which means that we introduce checks and reviews and making sure that, let's say, our money is not, how should I say, is in line with the objective of the Paris Agreement, including the money and the finance we provide to financial institutions. This means an engagement with our partner banks on supporting them in introducing climate risk considerations in the way they look at their business, in their portfolio, and goes up to the extent of working with them in improving their disclosure practices and their risk management practices. So we work with them with what we call transition plans. So this is, in a way, an engagement that entails the support to identify what type of steps they need to take in order to incorporate climate risk management practices within their operation. And perhaps the third level is about, as I mentioned before, we want to use financial institutions to provide climate resilience finance to support their clients in improving their capacity to manage climate risks. So in this respect, we're also working on creating specific financial products. And I can give you a couple of examples. We have credit lines that goes to SMEs that include technologies and solutions that address climate resilience objectives. We've been issuing as a financial institution ourselves climate resilience bonds. So it's also creating examples of how capital market can be used to enhance and increase climate adaptation finance. But also we are exploring new instruments, result-based finance, conditional lending, for example, sustainability linked loans, which introduce performance KPIs that, let's say, are designed to achieve climate resilience outcomes. So we believe that it's important to operate along these levels to indeed, create this ecosystem of practices, knowledge, experience that gradually will improve the way financial institutions are not only able to manage risks, but also become an agent of transformation in their markets.
Whether it's in Asia, where, I know you worked in India, or in Africa or somewhere else.
Sorry, I think I missed the question because for a moment the sound went off.
Yeah.
Again, I think we can't hear you from remote. Okay, now it's good.
Yeah. So my question was, is there an illustration to what you've just talked about, either in the context of India, where you worked before, or in Africa or Middle East?
I work personally in India, so actually I would be we're very glad to be there with you in India, but DBRD doesn't work in India. So one example is Egypt. You mentioned Africa. At the moment, we operate only in three countries in North Africa: Morocco, Tunisia, and Egypt. So these are all countries where we do provide this type of support to local banks in understanding climate risks in their portfolio, providing them with the knowledge about the tools and the practices, but also very much in introducing element of climate governance in the way the decisions are taken and the resources are allocated. So Egypt is a case where we've been working with several banks.
So what would be a large right? So what would be a large project that you're working on right now? Let's say in Egypt.
When it comes to the financial sector, you mean, or Well, in Egypt, we launched last year, this Chapter Zero, which was a big event because, again, including several non-executive directors from the corporate sector, financial institution, and this triggered, a quite substantial engagement in terms of initiatives, in terms of roundtables, in terms of sharing experience. So that is a good example. But also maybe one that is quite specific. We have something which we call Green Technology Selector, so which is business-to-business platform, is open platform where basically we identify technologies, broadly speaking, in mitigations, in energy efficiency, and in adaptation that can be used to support local banks prioritizing climate-related investments, and also identify, create, if you like, a platform to increase market penetration of these technology and practices. And we tend to link our credit lines to this, if you like, how should I say, program, and to accelerate, if you like, and facilitate the way local banks identify and support specific technologies, particularly in the SME sector.
Got it. Okay. Dr. Ratmar, I think it's over to you. Okay. Dr. Ratmar, can you hear me? No, I think she's frozen. So I'm going to come back to her a little later. Kathy, can you take over?
Good morning. I'm Kathy Boffman-McLeod, and I'm the CEO of Climate Resilience for All. And as we are solving a multifaceted challenge like climate change and all that it brings, we wear many hats. And so one thing that wasn't mentioned in my bio is that I was the global executive for environmental and social risk at Bank of America. And so my organization today is focused on protecting women in vulnerable communities from extreme heat. But I also played the role of designing and leading the first task force for climate-related financial disclosures report for Bank of America. And one of the things that I want to bring us to something very specific for just a few minutes, and when you come to something as rich in content as an ICDRI event, there are so many things that you hear. I want you to remember one thing from my intervention, and that is that extreme heat is a material risk for financial institutions, and that there are many, many solutions. But the biggest thing to understand is that we don't understand the size and shape and depth and quantified impact of extreme heat. We have the beginnings of an understanding of it. But when you think about this from a financial institution, how would you measure it? Many, many reports are coming out in the last few weeks about adaptation and resilience finance. And how should we accelerate our investment in it, and in investment in resilient infrastructure, the topic of our convening. And for the most part, extreme heat is mentioned, but not quantified. And that's because we need more data. We need to understand not just the temperature, but the humidity, and the temperature the day before, and the cloud cover, and the health, mortality, morbidity data of a community. And all of this drops right into the cost or loss in worker productivity, or your workforce and your business interruption, or your supply chain, or your infrastructure. And so just a few tidbits to put in your pocket. A worker in New Delhi who works outside every day loses a quarter of their income to extreme heat. 8% of Dhaka's GDP is lost every year and growing to extreme heat. An airplane cannot fly at 45 degrees, that's 120 in Fahrenheit, and your smartphone shuts down at 95 Fahrenheit and 35 C. So it is affecting us. And I would ask, would you raise your hand if heat, being hot, has changed your plans or affected the way you've set your schedule? Has anyone changed their travel plans because it's too hot? Do your kids play outside less? You think about when you're going to do something. You do it a little earlier or a little bit later. All of that has economic effect. And so it's not equal effect either. It has disproportionate impact on low-income workers, and particularly, just like Kanta Singh said this morning, on women. And women are disproportionately impacted. And when women make so many economic decisions and are big drivers in the economy, that's costing. And so how would a bank assess the cost of heat? And so while we know there are many solutions, including built environment solutions and early warning systems that are based on health, and so many technological solutions in addition to nature-based solutions, which are some of the most cost-effective solutions. How do we price them? How do we know the worker productivity losses we face? And so the work ahead is to quickly get the data that we need. 61,000 Europeans died in the summer of 2022, and all of those deaths were avoidable. And so as we see people getting sick and dying and the heat affecting us, we have to get this data available to financial institutions and to planners and investors to understand better what we're facing and how to fix it to save lives, but also keep heat from draining our economy. Thank you.
So, Kathy, quick question before I come to Dr. Rotman, and I hope we've got her back. So one is that I liked a statement that you made. You said that when women are resilient, we are all resilient. And I mean, I can see how that relates to what you said just now. But the interesting flip of this is, about the points you made, is that right now in the Indian stock markets, stock prices of air conditioner manufacturing companies, beverage companies, sugar companies are going up because of the heat waves that we are seeing and have been projected for this season. So how do you reconcile these two things? And I mean, if one can. And second, somewhat sort of off-the-cuff question, what made you quit your job at Bank of America and start this?
So the first question is, there are immense investment opportunities in adapting to extreme heat. And extreme heat is one topic and cooling is another. And the need for cold chain and chillers and air conditioning is growing. And so climate-friendly, efficient cooling machines are going to be very, very popular. Our need for understanding the risks that we face, whether that's in a construction site. You know, we work closely with a big engineering firm, and they have told us that they spend 10% more on managing extreme heat and managing health of their workers on their construction projects. And tomorrow, we'll have a session on infrastructure and heat and understanding what are the best practices and standards we want to build. So it is an opportunity, you're right, and thinking through what does a world look like that survives and thrives in those temperatures. And there's lots to say about this. You know, we need medicines chilled, we need to address the food insecurity that comes from extreme heat and the impacts on agriculture, and all sorts of interesting technologies, like things that sense that your fruits and vegetables are going bad, and you accelerate moving those vegetables, and you shorten and reduce the energy consumed. But the answer to the second question is, I want to help people, and I think that my passion to help people, and specifically now understanding that if we invest in women, if you look at the performance of companies with women on their boards, they have 30% more profit. Women leaders had fewer deaths from COVID. Women country leaders, they have lower carbon emissions. Companies perform better when women are on boards, as I said, but not just in financially, but also in all of the other dimensions of ESG and employee satisfaction. And so it makes sense to invest in women, and women are the backbone of communities and conversely disproportionately affected by climate impacts. And so I thought I could do more as an employee of a small group than one of 245,000 at Bank of America, which is a great bank, and I had a great experience. But anyway, thank you.
Okay. Do we have Dr. Retmer back with us? I can't see her. Okay. Alex, it's over to you.
Sure, thank you, Govind, and thanks everyone else. A really rich conversation already. I'm just going to frame this in Standard Chartered and kind of what we do, and then bring it onto the kind of topic of risk and opportunity, and to tug on some things that Kathy in particular has said, which were incredibly interesting. So, adaptation resilience is of huge importance for Standard Chartered, but why? We are an emerging markets bank, right? 85% of our sustainable finance assets located in Asia, Africa, Middle East. And as we all know, it's in these regions that extreme weather, climate-related natural hazards hit people and businesses the hardest. Interesting fact, if you look at Standard Chartered's footprint, we are, as I said, broadly low income, but more interestingly, 90% coastal. So adaptation, resilience, biodiversity, all of these are huge risks, but also big opportunities. And really, the markets we operate in require significant investment to allow communities to thrive and survive, as Kathy said. And kind of based on the reality of the climate impacts we've experienced today, it's there that we need to be investing, right? So Standard Chartered's ability to mobilize capital in developed markets and deploy it in developing markets is the reason that I work at Standard Chartered, Govind, in case you were going to ask. I feel that kind of unlocking of climate investment is massively urgent, right? We all know the figures. The adaptation gap is huge. Climate-related disasters are estimated to cost like $330 billion per year, and that's just the tip of the iceberg. You know, when you drill down into some of the stuff that Kathy was talking about in terms of the kind of costs on people's lives, actually, we don't have an idea what the cost is. It's huge. I think an interesting fact for me on risk and opportunity is actually in terms of what we need to do and the emissions and heating that is baked in terms of what's happening between now and let's say 2030, 2035, 2040, there is really great certainty around the near-term trajectory of climate change and the demand drivers for climate resilience, right? And these are uncorrelated and very independent from other market forces. So we know where we need to act and what we need to do. I think bringing risk and opportunity together, what we did a year and a half ago is publish a report called The Adaptation Economy. And what it did is rather than saying it's all doom and gloom, like there's no point, whatever, we looked at the cost benefit analysis of adaptation and resilience investments. And what I mean by that is, what does a dollar spent today do for the future? What is the cost save that you can lock in the future by investing a dollar today? And we did that in our kind of top 10 markets that were exposed to climate risk. So the Indias, Pakistan, Bangladesh, Kenya, Ghana, Nigeria, UAE, etc. And actually, the average was a dollar invested now will cost save a government up to $12 by 2040, right? So the case for adaptation and resilience investment isn't now, oh, these are not profitable, or it's the job of the government, or it'll never make any money. Actually, what this is saying is if you invest now, you save money in the future. What we've then published 2 weeks ago is the Guide for Adaptation and Resilience Finance. So what this does is sets out loads of investable opportunities and a bit of a kind of guide for the private sector as to how we can drive capital towards adaptation and resilience in emerging markets. And it then builds on that research, right? So the Smith School of Oxford, run by Nicola Ranger, who helped on our Guide for Adaptation and Resilience Finance, showed actually over the last 4 years, adaptation and resilience investments outperformed the median by 16% every year for the last 4 years. And these are the facts that we need to be hearing, right? It makes sense to invest in adaptation and resilience. Last point before I hand back to you, Govind, I think just kind of riffing on what Kathy said, in terms of climate injustice and in terms of the disproportionate effect of adaptation and resilience or lack thereof on marginalized communities such as women, I would like to also highlight Africa. Africa is kind of home for us. Some of our kind of key core footprint markets are there. Africa contributed less than 5% towards global emissions in history, right? But it will be the continent that is hit the hardest by the lack of adaptation and resilience. It's home to the biggest coastal megacities that are growing at such a rate, but also coastal erosion means that those cities are at risk, and these are vital trading partners for us. So in order to kind of be able to weather those systemic shocks, we need to invest in adaptation and resilience and turn that kind of climate risk assessment into climate opportunity.
Come back to you with a question or two, but I don't want to let, or rather lose Dr. Retmer again. So Dr. Retmer, if you're hearing me now, it's over to you. Okay, she's not. Okay, Alex, let me come back to with a quick question. I was seeing on your website that your the size of your assets, sustainability assets, have grown to almost $14 billion now. This was last year, and this had grown 30%. So when you say sustainable finance assets, what does that mean? And what would be, let's say, examples of the top 2 or 3 projects that you would be lending to and would fall under this definition?
Cool. Okay, good question. And I'll try and bring it back to adaptation and resilience if I can as well. So when we talk about our sustainable finance assets as a group, generally these are things that we have kind of defined, tagged as either green or social, and that we can then raise sustainable liabilities against. So our group issues sustainability bonds, for example, or we take sustainable deposits or sustainable notes, whatever it is. Now, our green and social assets are defined by our green and sustainable product framework, which is a kind of publicly available document that states what we call green, social, etc. And yes, you're right, these have grown kind of 30% year on year. I think the last count was 17 or $18 billion. The thing I like the most about this is that 90% of these are in Asia, Africa, and the Middle East. And now bringing it back to adaptation and resilience, adaptation and resilience mostly form part of our kind of green asset base, although as I'm sure you can argue, a lot of these have real spillover into the kind of social area. And interestingly, as we found out from the Guide for Adaptation and Resilience Finance when we wrote that in the last 6 months, there are some assets potentially that would be adaptation and resilience but wouldn't be green. And that's quite an interesting tension. You can build a living seawall to protect a coastal piece of infrastructure, and that's adaptation, green, social, biodiversity, or you can protect it with a big piece of concrete, right? And that is absolutely adaptation and resilience, but it's probably not green. So those are the kind of interesting tensions there. The biggest projects, Govind, if we're going to talk about adaptation and resilience, we've got a lot of kind of water projects that help provide clean water. And then very interestingly, one that kind of tugs on some mental threads for me is the desal or desalinization assets we have, because clearly clean water is important for everyone. But also when you think about do no significant harm and maladaptation, desalinization assets are of particular interest here, right? Because they use a lot of power and also they produce a lot of brine. And you need some kind of systems in place to manage the brine, and you need to figure out how you can run these things on more renewable power. And those are the cornerstones of good adaptation and resilience investments, right? You need to avoid doing significant harm to other sustainability objectives, and you need to try not to lock in any maladaptation to ensure actually that particular asset is doing what it's supposed to do. So providing clean water and not messing anything else up.
Right. Dr. Retmer, we are back to you.
Thanks a lot, Koinraj. Thanks for the excellent moderation. We had, in fact, a power outage, so exactly what we wanted to talk about as well. So let me pick up power in a moment as well. We heard that already. If we look at recent World Bank publications, they estimate that till 2026, there's a 2 trillion investment and financing need coming up in adaptation, right? So I think we're all aware that it's an opportunity story. And I think this is crucial if I look at my past 20 years of working with banks, right? If we have to go through effort, there is a big pie at the end of that effort, right? So where do we see the challenges? The first one that tends to come up is the question around, do I have a risk or not? And the guiding principle ever since the TCFD was invigorated has to be materiality. So how do we understand materiality? I've seen so many clients spending tons of time around understanding hazards and their drivers and vulnerabilities to hazards, but that doesn't necessarily mean it's a financial impact. So the first question is really, where does my money lie? Where do I really have financial impact independent of whether the hazard is supposed, depending on the data that you use, to increase by 200%, 500%, or 20%, because the 20% might be a lot more relevant than the 500, given your exposure. This links to the second question around what is my specific portfolio. We all, I think by now have understood, we need to go down to the sector level, at least the sector level. So what is really in? So which questions am I trying to answer? If I have a certain sector portfolio, there might be hazards I can simply ignore. So I shouldn't spend my time trying to get the best response, waiting for the most excellent data, if I know in the end whatever comes out isn't relevant. Going to the infrastructure point, typically when you look at infrastructure financing, there's very, very strong methods in place, a lot stronger than you would see in the corporate sector, around risk assessments for this one piece of infrastructure. So we do have an excellent basis with the people performing these analyses. For them, it's rather learning this language around climate-related risks or the disaster-related risks and understanding the impact mechanism. The implementation then, be it at the market side, be it at the risk side, tends to be a lot easier, because in the end, you're kind of translating an individual cash flow and just adding something to that cash flow, and then put it back into your PD calculation and your loss given default, which is established standard practices. Where do we see common mistakes in that space? I think one is, and that's an answer that I hear a lot, well, there's going to be insurance. I had the pleasure of working with Unit FI and 22 leading insurance companies, and just rest assured, they might be ahead in terms of their risk assessment, and they might choose not to finance anymore. And we've seen that across the board, right? So does that ecosystem that people are used to, is that still in place for risk management? I think is a key question. There's another element that we're struggling with, and NGFS is doing a strong work around getting our arms around it. There's one element around, I have an individual infrastructure exposure, and that might be at risk, but these infrastructures tend to be in countries with a potentially higher country level risk. So what does an infrastructure damage do to the country rating? How does that impact social stability, the capacity and the willingness of the state to act in a case of disaster? All of that links back to an indirect risk that needs to be considered. Let me go to the measures point, because some of the arguments are, well, there might be measures in place and I can build these measures in at this point in time. This is getting more tricky even than what we've been talking around so far, because we're moving to risk distribution. If I choose to finance an adaptation measure, what is my risk position in this? What is my cash flow and what is my risk position in this? Does the state jump in? Does the state not jump in? Is it a purely privately financed investment? Do I have dependencies on my cash flow that are, however, in the hands of others? So the complexity starts to kind of explode around the edges, which often leads to the question of why I don't have the time right now. Why do I care? This somebody else has to solve it. Present it to me, what I need to do, and then I can take it with it from there. And we see it on the climate mitigation side, and I think that's a positive note. There's so much work that has moved into climate mitigation and finding transition financing measures, testing existing and new elements. There's so much discussion after COP around guarantee mechanisms. So there's, I guess, elements that can be used for adaptation, which allows for a quick scaling of adaptation. A last element maybe around the ecosystem point, and ecosystems can be understood very broadly. I'm talking about ecosystems very broadly at this point. So I already mentioned country level risk and the willingness of the state to be part of an adaptation program. Beyond that, if I want to, as a bank, want to assess whether adaptation measure A, B, or C is the right one, it's kind of not in my typical core competence profile, right? I'm not a construction engineer. I probably don't want to build the expertise. So who do I need in my ecosystem to make sure that I get the right expertise for that project that I want to finance, if you want to finance it as a project? And second, how do I make sure that the promises that I get are the ones that will be sustained? Positive note on that, I guess the data question it's still being raised. We're just doing a broad global interview series with leading banks. So it's still a point, but we hear more and more, well, it's not an excuse. And I can totally relate to that. Also, given what kind of AI is providing to us in terms of data, physical risk overlays are providing us in terms of data. So positive notion on that. Let me quickly talk about urgency. So there's one urgency around, it's kind of ironic if you follow the insurance statistics around what are the record years of damages in the insurance industry, knowing that only 30% of the damages are insured in the first place. So we will see more and more of these risks. At the same time, there's heavy investment after COP around building the transition infrastructure, right? So tripling renewables, just energy, transition partnerships, etc. So we will build more and more infrastructure, especially in the global south. So the need, again, this is a major opportunity, but the need to shield that infrastructure, linking, for example, to power with the examples I just mentioned, is just increasing. So if banks choose to take part in this or take a share in the pie that is coming up there, adaptation has to be an integral part of that discussion. Last point, Alex, echoing what you said, we're not operating on an island, right? So there's at least a significant social link that we need to consider. So how do we deal with this? There is at least a significant biodiversity nature linked to that. So a new opportunity in nature-based assets, which we also see in the global south and recent regulations. And there's a lot more interconnection points. Jean-Pierre, you mentioned circularity. So this will change business cases again, right? Infrastructure requirements again, which is another overlay. But I take that out, and I guess my petitum for banks would be: don't hesitate because you don't have the right data. Make sure that whenever you're investing, give your teams the right kind of initial risk assessment in the first place, and just be sure that you build your ecosystems and you're acting in a broader ecosystem when you start financing or when you extend your financing, especially in the global south. Thank you.
Thank you. Alex, did you want to come in on something?
Yeah, I just wanted to pick up on something that Nicole said in terms of biodiversity, and actually, there's a lot more to it than that, right? I think something I've learned in the last few months in this publishing of this guide for adaptation and resilience finance, which we published, by the way, alongside KPMG and the UNDRR. So speaking of disaster reduction, I think the main point that I would say after having spent kind of a year on this guide is that adaptation and resilience is the answer no matter what your question is, right? And what I mean by that is there are so many co-benefits to adaptation and resilience, so many. Generally, when you think something is adaptation resilience finance and you think it's only that, it's not. It's green, it's biodiversity, it's social, it's something else. And what the guide that we published does is it has our kind of over 100 list of investable opportunities and adaptation and resilience on one side, and on the top, it's got, you know, green bond principles, social bond principles, biodiversity, transition, etc. So if you care about biodiversity and you're running a biodiversity fund, you can check actually how much of my holdings are biodiversity and how much of them also are co-benefits with adaptation and resilience or with something else. And I think actually when you make something everyone else's problem, we can really figure out how we can crowd that private sector capital en masse towards adaptation and resilience, because chances are it's doing something else as well.
Okay, so questions from folks here to our panel? Anyone? Okay, so while you think about it, let me, a couple of quick questions, and Vivek, let me come back to you. So a lot of this boils down to pricing, right? I mean, it is, if you price your risk effectively, it's like getting a loan at 8% versus 18%. And at 8, I mean, there are fewer people willing to pay 18%, but they're willing to. So how does this situation or scenario change? And how is it changing, Raju?
That's a tricky question, to be honest. I mean, typically, the bankers or the financial institutions price their risk according to how the ecosystem is moving and how the response to their portfolios, what response they are receiving. In the events of defaults, they use certain parameters or indicators, say value at risk or cash flow at risk, to assess the impact of those defaults on their portfolio. But for climate-induced risk, probably something called climate VAR would have to be developed. The traditional VAR method wouldn't work. Something additional will have to be added to that. Also to point out that the bankers would now have to engage more frequently into scenario analysis and stress testing. because that's the only way they can periodically check how their portfolio or how their assets are behaving.
But I think, as Smita was saying, now it's a regulatory requirement as well.
It's a regulatory requirement, but there is lack of data. So something called climate war kind of a situation doesn't exist. A traditional war happens, right? That's a normal practice. You stress test, but you have to stress test against the different scenarios. So 2.5 versus 4 versus 1.5. And then you have to find out what is the impact on your portfolio. Now, for example, Bowen did a research, and he said in a business as usual scenario at a 2.5 degree curve, the climate-induced war can be 1.8% on any financial institution. Now, that's a huge number. So you add that up to your traditional model and then price your risk. So that's one of the ways of doing it.
Okay, Smita, do you want to jump in on this? On pricing risk and
No, I think,
or
yeah.
pricing in general when it comes to...
So I think Vivek has covered it. And the bigger challenge, like Vivek was talking about, is how do we navigate the present systems, in terms of, I would go back to the point of data and capacities. And for this, I think there is a regulatory push which is needed, not in terms of guidelines alone, but also in terms of, see, when the regulator is actually talking about these things, there is a level playing field. The borrower is not inclined to go to a bank who is not asking this data, because that's the natural tendency. So any banker we talk to, they say, why do we have to do it? Because the borrower will go to some other bank, and I'm going to lose out my business. So to make it a business case, and because banking is so regulated, the push has to come from the regulator.
Got it. Any questions very quickly from anyone? Yes, there. Go ahead.
Hello, good afternoon, everybody. Thank you, panel, for sharing your views and such an amazing experience. My name is Hemlata. I am a scientist from India Med Department. My question is for Ms. Kyati. So, thank you for your excellent work in the field of women resilience against heat program. My question is, which initiative or program you found is most promising in delivering results for women resilience against extreme heat programs?
Thank you very much for the question. We have just come on risk with 52,000 women members of the Self-Employed Women's Association, a labor union of 3 million women here in India in 18 states, headquartered in Gujarat and Ahmedabad. And the program is a layer of micro parametric insurance, and ICICI Lombard and Swiss Re are our partners, and Sumit Gupta is here from Swiss Re today. And there's a cash layer, and there's a layer of early warning system, and then financial inclusion, each member has their own bank account. And so these are, when you think about identifying risk, measuring risk, reducing risk, and transferring risk, this program has an element of risk reduction, risk transfer, and quantification in terms of understanding the metrics and evaluation of how the program works. And so this is the second year of the program. We've added a cash layer at the lower temperatures because heat is, even at the lower temperatures, still impacting women's income. And the key is to sustain or grow women's income and choice and opportunity. And so there are other programs, but this is a new field. And so far, that's shown early success. And then secondly, a paper has recently come out in Scientific Papers of the Nature journal. We experimented with naming heat waves, and naming heat waves attached to a health-based early warning system. And the paper shows early evidence that heat wave naming works to get people to change their behavior and to understand the size of the danger of extreme heat. So those are two quick answers.
Got it. Any other questions? No. Okay. We're running to the end of the show, so I'm going to ask all our speakers to give 2 points, okay? So one is, from our conversation so far, what's the positive thing that you've taken away looking ahead? And secondly, what's the challenge in the context of finance for climate risk and, for climate risk and disasters. So I'm going to start with Jean-Pierre, if that's okay.
Sure.
And if you're hearing me. Yeah, so
yes.
one positive forward-looking conclusion, and secondly, a challenge, whichever way you want to put it.
The positive conclusion is that there's been a huge acceleration in understanding and the awareness and the level of activity in the financial sector and beyond. So, and I think this acceleration is not going to stop. So that's very positive and is observable. The other point I want to make, we talked about sectoral risk, we talked about best practice. But one point which is very important is about interdependencies, across sectors and across themes. And I'll give you one example. And this is particularly important for the financial sector. If you look at, say, manufacturing, in many cases, the underlying climate risk, physical climate risk can be limited. But ultimately, if you look at the impact, say, of infrastructure on a manufacturing business in terms of disruption in transport, in terms of disruptive communication, can be very substantial. So understanding the sectoral interdependence is an important element that introduces a higher degree of complexity, but so the role of critical infrastructure in this respect is very important. And thematically, Alex mentioned desalinization project. This is absolutely important to observe best practice. But let's say you also need to complement, for example, with optimal demand side, water use technologies and solutions, proper tariffs in terms of, pricing water. So all these elements needs to be brought together in order to have more systemic impact. Thanks.
Other speakers to keep it about 30 seconds. And Dr. Retmer, can you go next? We're really short in time.
Sure. So positive notion, I think if you look at the past 10 years, we have made incredible progress on climate risk integration. Anybody who has started thinking about it, for that person, it's easy to pick up physical risk and disaster risk as well. Slightly different nature, but same underlying logic. I think the second, which is a challenge, is we need more ecosystems, also at the intersection to technology. If I look at what we're doing with building ecosystems around hydrogen infrastructure, for example, but then also with our alliances, Google, AI, etc. There's so many things to piggyback on and to use as accelerators. And I guess we probably have to be more transparent around that, because then the journey is going to be a lot easier.
Alex?
Yeah, okay, so two things. One, no solution is perfect. We've kind of talked through that before. Jean-Pierre mentioned it with desal, but doesn't mean that we shouldn't try. We should absolutely try to drive capital towards adaptation and resilience finance, but bearing in mind that we should look at do no significant harm and maladaptation. Second one is challenge what you've heard before. So when people say it's just the government's job or we'll never make any money out of these, challenge that. Really, we've got all of the tools we need to drive capital towards adaptation and resilience. Now feels like the time. It feels like 10 years ago when we were looking at green finance, when we knew the size of the green finance gap, but we didn't have the tools. We know the size of the adaptation finance gap and we have the tools. So now is the time, and I'm excited to be part of it.
Okay, Smita?
Yeah, the positive note is climate change is not just risks, it's also opens up a lot of opportunities for financial institutions to innovate on products, structures, and tap this whole space, as our previous speakers also spoke about. And I think there needs to be a more partnership, stakeholder consultations, working together, because it's such a complex space and everybody's learning.
And that seems to be one of the strong underlying themes
of this
today.
Session,
yeah. Vivek?
So
and then Kathy, last word. Yeah.
The positive thing that I took is that financial institutions have opportunities, build back better. That means they will have avenues to spend once the disaster has struck. So rehabilitation. And the challenge that I see is lack of data.
Okay, Kathy?
The opportunity, we need to put disaster risk financing and insurance into the capital stack for adaptation and resilience. Think about this as a comprehensive capital stack. We're going to have to use lots of different parts of capital to maximize this opportunity. I'm not going to say there's a challenge. We have everything we need to do this. We have everything we need. Let's just do it.
Okay. Thank you very much. We've run out of time completely, so I'm not going to press further with any conclusions or concluding statements. Thank you to CDRI for inviting me as well, and may I hand it back to the Master of Ceremonies.
Thank you, Mr. Govindraj, and thank you, the panelists. Kindly stay back for a group photograph. We now will present the certificates for all the panelists.
To this short session. It's the ICDRI Showcase. ICDRI, as you all may be aware, is the Global Infrastructure Risk Model and Resilience Index. This was a key offering launched as part of the first edition of CDRI's flagship global report on global infrastructure resilience. It's the first fully probabilistic global risk assessment of infrastructure assets in key sectors. Under this initiative, a fully operational data platform is now live. It has been developed by a consortium of 4 global organizations. It empowers users to access and analyze a complete range of risk metrics, acting as a catalyst for informed decision-making and proactive risk management. Before we begin our conversation with Andrew Maskry, there's a short video providing an overview of GIRI. Can we have the video, please?
GIRI is a tool for policymakers and investors to understand potential risks to their country's infrastructure. It can be thought of as an atlas, which directs decision makers towards investments in resilience. In Bangladesh, for example, GIRI shows that investments in resilience to floods would help to protect essential services. In Chile, meanwhile, GIRI highlights the need for the power sector to be resilient to earthquakes. By indicating risks from natural hazards and climate change to critical infrastructure, GIRI showcases the resilience dividend to be gained by investing today for a more resilient tomorrow.
Andrew Maskry, the discussant for today. Andrew is an urban planner. He holds a doctorate in disaster risk management and a postgraduate degree in geographical information systems. He has worked as the chief of the Disaster Reduction and Recovery Unit at UNDP and has been the coordinator of the United Nations Global Assessment Report on Disaster Risk Reduction, the GAR report, producing 5 editions of GAR between 2009 and 2017. He has worked as an advisor to the Council of Ministries of the Government of Peru, the Global Center for Disaster Statistics, the Islamic Development Bank, the Asian Development Bank, amongst others. He was the coordinating lead author for the first edition of CDRI's biennial report and is an advisor for the second edition. So, Andrew, welcome to the discussion. My first question to you would be to really provide insights into the GIRI model itself. Could you talk about the inner workings of GIRI, specifically how it utilizes probabilistic risk assessment to offer a comprehensive understanding of infrastructure risks spanning across different sectors and hazards?
Thank you very much, Swapnil. Is this working? Yeah. I'm not going to describe the inner workings, but a little bit like the outer workings, because the outer workings is what people will see. They won't see the inner workings. But a few words about GIRI. The first thing is it is completely probabilistic. So those of you familiar with the way the insurance industry and catastrophe modeling companies address risk, this will be extremely familiar to you because we use basically exactly the same conceptual framework and methodology. The difference is GIRI isn't applied to a specific portfolio of assets. It's applied to, all the infrastructure assets of the world. So I think one of the, let's say 3 characteristics of GIRI I'd like to really emphasize to the user. One is that it covers every single country and territory in the world. It's completely global. It doesn't leave out anywhere. The second thing is we've tried to cover systematically all the principal infrastructure sectors. So it has power and energy, telecommunications, water and wastewater, roads and railways, other transport infrastructure, health and education, and actually housing and the rest of the building stock as well, which is important. And we've tried to cover most, not all, of the principal natural hazards out there. So it covers cyclonic wind, storm surge, flood, landslide, earthquake, and tsunami. There are gaps, we can talk about that later on. But I think for the user, it's for the first time ever, we now actually have figures, quantitative figures, dollar values, of the contingent liability that over the years and the decades we've been building infrastructure has become internalized in the world's infrastructure systems. So I'll stop there because I know you have other questions.
Thank you. So you spoke about the GIRI data being a publicly available set of metrics. Your thoughts on how do you envision that GIRI, how could it play a role in influencing policy, investments, and actions of different stakeholder groups who will be users of GIRI. So if you could shed light on that.
Thanks, Swapnil. Yes, I mean, I'll refer back to a phrase that Dr. P.K. Mishra used in his introductory speech. He said that if we don't actually strengthen resilience, making new investments is like pouring water into a bamboo basket. You pour the water in and it flows straight out again. And I think what GIRI actually does, it can tell policymakers and planners, if I pour so much water into the basket, this is how much is actually going to flow out, which is really the concept of contingent liability. So if I'm sitting in, let's say the government of Peru, and I want to know what is the contingent liability of my road network to a given hazard, let's say landslides, it can give me that figure. Now, if that figure is, low, it means, future investments, I'll have to probably make some adjustments for resilience, but it's not going to be a huge problem. But if I find out that my contingent liability represents a very high proportion of the asset value or of my expected future investment, it means I'm going to have to look very, very seriously about how I strengthen resilience in that area. So I think it's useful for governments, anyone in charge of public investment in governments or infrastructure planning. It's obviously useful for the private investor as well. We've heard in the last session about, the importance of estimating, risk-adjusted returns, so it can help us do that. I personally, when I've looked at projects funded by some of the multilateral development banks in the past, I've been actually shocked, and this is recent years, of seeing how, risk-adjusted returns do not take into account a lot of these contingent liabilities. So this is so important for us. So for investors, for governments, and also I think it's, can provide, in a sense, a framework, a language in which we can actually start to compare risk across infrastructure sectors, across countries, and across hazards, and then actually have a dialogue about how to reduce that.
Thank you for that. So, Andrew, if we zoom in a bit and we talk about, the key findings of GIRI, which feature in the report, also about its scale and application, do you have in mind some examples of key findings from GIRI, that provide insights regarding the resilience of infrastructure assets across different territories? If you could focus on some of the LMICs or the SIDS that feature in the report. Yeah.
Well, the report and GIRI itself is full of data, so I'll just highlight a few things. We estimated the total average annual loss, so this is the average loss one can expect over the long term, across all infrastructure sectors in the world, to be around $700 billion. Now, I think that represented, when we looked at it in the report, something like 14% of 2002 global GDP growth. So that in itself is quite a damning statistic, because even with the climate as it is now, infrastructure as it is now, that just shows how much of GDP growth we're losing by not strengthening resilience. When you drill down, you can then see how the problem is actually significantly worse for lower income countries, lower middle income countries than it is for high income countries. High income countries have the bulk of the exposure, exposed assets, but have far lower risk. Lower income countries have a lesser proportion of the exposed assets, but have higher risk. And you mentioned, SIDS. This is probably the most extreme case where, the relative risk is amongst the highest in the world. We have to look at both the absolute risk, the absolute contingent liability a country has, but also its relative risk in terms of as a proportion of a capital stock in GDP. So the model, very, very clearly indicates groups of countries and specific geographies which need to be looked at with care.
Thank you. One key piece of work as part of the GIRI initiative was the development of the data platform, done, of course, by the consortium, but led by UNEP Grid. A colleague from UNEP Grid, Andrea De Bono, is also here, and he'll be up on stage in a bit demonstrating the platform to you. But Andrew, one last question to you, if you could, explain the process, because it was a complex process, it was a rigorous process to develop this fully operational data platform. How do you think it will empower users to engage with the platform and use the financial risk metric available in its current version?
Well, I mean, the platform's out there. It's completely available. It's completely open. So it's one of the things we wanted to do with this, in a sense, is open the black box. Because a lot of the proprietary models which the insurance industry and others use to estimate risk aren't open to anyone. So I think it's a fantastic opportunity to actually start a debate on risk. I often get asked the question, I mean, are the numbers accurate or not? I mean, they're as accurate as any model is. But I think the objective of the numbers is to actually start a debate about risk, and this is what we really hope happens, risk and resilience. Thank you.
Thank you, Andrew. Since we're running out of time, I will invite Andrea De Bono. Andrea, if you're here, please could you come up on stage? Andrea will be presenting, taking us through a demonstration of the GIRI data platform. He holds a PhD. He joined UNEP Grid in Geneva in 2001 and presently leads the Data and Information Sustainability Unit there. His career began as a GIS analyst and data manager for numerous UN projects addressing topics like urbanization, renewable energy, land management, and disasters. In recent years, his primary focus has shifted to managing platforms for visualizing and distributing environmental data for UNEP and other UN organizations. Over to you, Andrea, and perhaps Andrew and myself can join the audience when Andrea takes over. Thank you.
Thank you so much. And welcome into a world of data that will arrive after. I take the occasion to say that the platform that I will present you now is also available in the main screen outside the room, so you can play a little bit later if you want. So there are three main sections on the platform, because of course it's a platform to show the data set, but not only. It's very important to put the data in their context. So we have one section is more for map vision, data for hazard and exposure at global scale, visualized under like map with the pixel style. And you have a section more on the risk metrics based on country profile or comparison between the different countries, and is under the view of a dynamic dashboards. And the third section, I will start with this one, is the information layer. So it's very, very important to give the information in the context. So we start around three levels. The first one is the general information. So we have a glossary, we have detailed methodology with all the paper that we published. Is more technical paper in order to understand the methodology, the data used, and the next steps, and so and so. And for people who want to go a little bit more further, all the literature behind our studies. This is the first level. The second level is the information by the different topics. So you will see later that we have different subjects. And for each of the subjects, we have a very snapshot, a very short methodology in a nutshell in order to quickly understand what you are speaking for. This is, for example, for the exposure model. This is for the flood hazard. And the third level of information, when you go in deep on the different data set, you can click and you have the access to the classical metadata about what is this indicator, who prepared, and the license. And of course, there are another level that is, if you need more support or specific question, you can always contact us. So we start with a very, very short tour about the risk matrix. So here is a page. You go in the risk matrix. Here you have a selection of the different topics. Here we can select about if you want to have a country profile or comparison with different country. And here we have the data frame for the interactive visualization. You have some control, for example, you can change the country or other kind of selection. So try to answer a questions. For example, we are in we are in the main section, in the introductory section. We focus on the country profile. In this case, we are in the Philippines. The first question: what is the overall average annual losses of the country? You can see there. What are the main hazards and how much they affect the countries? And we can see in this case that there are three main hazards with also the amount of the average annual losses in million. These are earthquake, floods, and tropical cyclone. And the third question: how are the main infrastructure affected? We can see there in this chart that water and wastewater are more affected by earthquake than oil and gas, for example, that are more affected by tropical cyclone. If you want to have some answer concerning how the climate, the different climate scenarios affect our structure, we can focus on this part of the platform, where we see at global, like aggregated level, that the upper boundary is quite important for this country. We are in Nepal for this example, and you have also evaluation of the annual average losses in $1 million. And also, if you go a little bit more in detail by infrastructure, for example, you see that you have two kinds of infrastructure. One is building, and the other is telecommunication, that are more affected by climatic scenario than the others. And if you want to go a little bit more in detail, and so we can choose a specific hazard, you have, again, information about the different infrastructure, and also with more detail for each of the infrastructure. So, for example, for power, we have the transmission, the power production, and so and so. And also, we have more detailed risk matrix for each of the different infrastructure, how you can see in the right screen. Here, for cyclonic example, we are always in Philippines. We have the losses caused by wind and the losses caused by surge. Very fast overview concerning the possibility to make comparison between the countries. So you can choose a region or a continent, and inside this continent you can choose a country that have a similar income as classified, defined by the World Bank, and or you can choose different countries as you want, and see, you can see the different. Your country was always Philippines among the other country. What is what's happening? Let's go to the map viewer, to the geospatial section. So you have basically two panels. One is for choosing the different layers, and the other one is for the visualization. There are three types of data manipulation. So we can go in the first screen. We have a selection by the team of the most significant important layers. We have all the list of the layers. It's around more than 100 now, so a lot of. And this is a third section where you create your workspace with your layer in order to make some specific analysis or share with other people. I have a very short animation. Okay, so you can visualize your layers. We are in Ethiopia, and we choose a flood hazard layers. Some information we can play like in classically platform with some parameters like transparency and so on. We zoom a little bit, and we will also add another layers. For example, this is landslides. Also, we can add the basic information. Now we will fly a little bit. We have a possibility to have a 3D models and zoom a lot. Even if it's not an application for land planning, it's a global application anyway. And after, you can see the legend of the different layer. If you need to have a little bit more in deep, you can create your space of works. So you can choose a layer with free text or using keyword. After this, you select your layer and you go in your whitespace where you can play with the order of the layers, share each of the layers with the social, different social web possibility, and of course download the layer in GIS format and share through the URL your workspace with other people in your organization or elsewhere. Of course, all the data, both the maps, geospatial data, and the risk data set are fully accessible, okay? It's, everything is built with using open source data and have a public license, it's a Creative Commons, so you can share, you can use. The next steps will be, after the launch of the platform was done in the COP28, we had a lot of very intensive phases of feedback between the CDRI teams and external person. So, but we have some more wishes that we want to apply to the future version of the platform. So we are the next steps are ongoing. As very last slide, is only to show you that everything is built using open source open source application like these two kind of modules. But I don't want to take time on this and go straight to the thanks page. So thanks to all the people of the consortium, thanks to CDRI. So it's all. Thank you very much for your attention. And if you want to see something more, don't forget the screen outside the room.
Of the Global Infrastructure Risk Model and Resilience Index. Now we move on to the lunch break, and before that I'll just request the panelists for the session to just quickly gather for a group photograph and the presentation of certificates. Thank you.